supply and the significant demand. Does that make sense? Okay. PIP, sort of. I mean, it's a little more to it than that, but we'll get to that in just a few minutes. Okay. So if you're new to this, you've got my email address there, and let's dive into the markets and look at some price charts and try to map all this out. If you have any markets you want me to go over, just let me know, and we can go over them. All right. Sorry about that. There we go. So, yep, we'll look at the. Sure, we can start with the. We can get to the British pound in just a minute. Okay. But first, it's probably best that we start with the dollar. Okay. Actually, to get the most out of this session, for me to make the most out of the session for you, if you don't mind in the chat, what markets do you trade? Is it forex? Is it futures? Is it spot forex? Is it options, equity index markets, stocks? Mainly forex. No surprise there. Okay. Since we have the S&P up, why don't we take a look at it, and specifically the Nasdaq. So I deliver live trading and analysis sessions every morning for a group, uh, for a group inside Online Trading Academy, and I'm sharing a workspace that I have with you, or that I use every morning here. So we've recently come into a supply zone that we've had planned out for quite a while. There it is, in the Nasdaq, up at 7607. That's 7607. So as you can see, we've run into that a couple times. We've also hit our demand zone at 75.2650. So these are levels that we plan well in advance. Okay. And right now, we're kind of sitting almost in the middle. But neither the supply side on top or the demand below are fresh. And fresh is key, meaning, has price been back there since it's been there, or not? So the equity index markets, at least where they're at right now, can pretty easily move higher or lower. But once they get up into this supply or down into this demand, we'd expect them to, change direction again. And I notice there's some people with us here that trade the S&P, Dow, Nasdaq, and all that. So let me take you over quickly to the Dow, um, because there's a special opportunity here. Now, if you take a look at, so the Dow in the bigger picture, Friday, it gapped right into our supply zone. See that? And it's no surprise that now we're gapping down out of that supply zone, because only a novice trader would buy on Friday up into that supply zone. Does that make sense? So now we're moving lower. If you're in this trade, great. If you're not in it and want to be in it, and we take a look at the 60-minute chart, we could see that we had a, in the overall stock market, we had a gap down this morning, creating a nice supply zone above. So if we do get a rally back up to the 26,395 level in the Dow, we'd be looking to take a short position here with a stop just above the level and a target of just before this demand zone below. Does that make sense? Everything we do, everything I do with the strategy is very rule based. Okay, there shouldn't be any subjectivity in it or anything like that. I developed the strategy many years ago on the trading floor of the Chicago Mercantile Exchange. There I was handling institutional order flow and actually had the market supply and demand right at my fingertips. So with that, I simply looked at price charts to figure out where these big orders were that I was handling. And these are what the pictures look like. Does everybody understand that? No questions on that? So this opportunity in the Dow is the same in most of the equity index markets. If we go over to the S&P, um, again, price went into our supply zone. It's now slowly falling out of that. If we go over here to, let's see here, did this hit our demand zone? It did not. So you can see in the Dow and the S&P, here's a demand zone that I gave the group this morning. We didn't reach our demand zone below, but if we do turn lower, expect to bounce higher if the S&P reaches 2882.50. Okay, and then on the downside, so here's the demand in the overall equity index markets this morning. We can see it clearly on the S&P. For the supply side, the Dow 60-minute chart is a good one to look at. Okay. We have similar levels in the S&P. It's just very clear on the Dows. Everybody understand that? And you'll see over time in these sessions, you'll be able to pretty consistently predict the highs and lows of the week, for example, in the equity index markets. Not necessarily to the penny, but that's not what we're trying to do. Just the general zones, right? And for those that are in my, the morning sessions, you see that every week. And we can move on from this, but before we get on to any other equity index markets, why don't we look at the dollar? Okay. Yeah, my volume should be okay. I just looked back in the chat. Looks like some people may be having volume issues, but it should be fine. So the dollar has moved from our 4-hour demand zone and rallied quite a bit. And now it recently hit our 60-minute supply zone. So this is the supply zone that we've had in the morning sessions, and now it's falling. Okay. There's plenty of room to fall. Anybody here with us, with me in the morning sessions? Maybe because a lot of people are long the euro from this. One of the challenges with having a session right now is because these moves are well underway from our turning points. Not a whole lot to do in the, right here. If you're not short, long the euro, short dollar, we can look inside this decline, and let's do that on a smaller time frame. Okay, there we go. So if the dollar does happen to rally up to, let's put this level in right here, and I'm actually going to combine a couple levels for you. This is 97.18 to 24. That's 97.18 to 24. Everybody see that? We'll look at your 96 demand zone in just a minute. So if you're not short dollars from 97.50, the supply area, you do have another place to possibly get in here. Now remember, this supply zone here is never going to be as high odds as the supply zone that I just showed you above. Okay. So 96 demand zone, let's take a look. Let's go back to our 60-minute chart. At 96, so you're looking at this area here. Yeah, we wouldn't call that demand. In fact, our demand zone was 95.75, so we'd look a little bit lower than that. See the demand zone down there? That was the fresh zone. All right. No, not at all, Haji. Trading the strategy on any time frame, one is not better than the other. They're all the same. It's just that when you trade smaller time frames, you have to do a little bit extra work. Because anytime you're taking a small time frame supply or demand level, you need to know where that supply or demand level is in the context of the bigger picture. Okay. Like, for example, oil, I believe. Let's take a look at oil. Oil is getting close to, I'll show you here in just a second. See how oil is getting close to our larger time frame supply? It's hard to see right there, but so this supply zone's here. Now you can see it better. And let me actually blow it up even more. This supply zone up here, you can see how oil, so that zone comes in at 64.85, and we're now at 64.17. So that supply zone is just a little bit higher. So as prices get closer to this supply zone that we see on a larger time frame, this is a 4-hour chart, um, all day trading to the long side up here is probably not a good idea. So that we would kind of turn that switch off. But supply zones that show up in the smaller time frames for day trading opportunity are going to be very high odds. So it's not like one time frame or another is better than the other. It's just we need to do a little extra work to make sure you have every decision needs to be made in the context of where price is in the bigger picture. Location, 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 just like real estate. All right. EP, I see your question there. Yeah, so you want to make sure that you have, yeah, well the main point is one candle. I see some people say, oh, there's a supplier demand zone there, and they're looking at one candle or one bar on a chart. Well, I would never call if you have one candle or price point in a base, I would never call that a supplier demand zone. What that should do is get you to go down to a smaller time frame and look inside that area. Okay, so let's say you're on a 60-minute chart and you see, one, oh, this is a great example right here. Watch. If I go to the daily chart of, if I go to the daily chart of oil, well, I guess you see two there, but see how there's like maybe two red candles in that base? But let's pretend for a second that there was one. I would never take that and call it demand. What I would do is go down to a smaller time frame, which is this one. And now I look inside that area and say, okay, that level looks pretty good, right? Because it may not, and it doesn't look good just because we've added candles. Obviously, that's going to happen. But we have other evidence that we didn't have by looking at the bigger time frame. Okay. So why don't we go over to the pound? I know a few people wanted the pound. Let's go over to the spot pound. And again, we've already got some levels there that we've been trading off of. Remember, I do these sessions every day, so we're very, very in tune with where overall supply and demand is in the major markets around the world. It's kind of our full-time job here, right? To figure that out. So in the pound, we've been trading off of our weekly supply during all this Brexit stuff. And of course, we have some daily supply too that you wouldn't see on that larger time frame. And the market's just been, hitting that and declining from it. There's room to the demand side below. But the way that we do this, so right now we don't see any demand. None of these candles, none of this price action below current price represents demand. It doesn't mean it's not there. It just means what we're looking at doesn't represent it. So we want to look at smaller time frames, and let's go do that to see where the demand is below. So I'll start with this time frame right here. Well, now we see, and again, this level didn't show up on another time frame, that we likely have a little bit of demand sitting right down here, the 129.23 area. And I'll put a little box around that so it's very clear. All right. And most of these opportunities that we're looking at, if they're against the dollar, we also want to look at the dollar before even thinking of taking a trade and make sure that, again, for most of these, not all of them, for most of them, that the dollar has an opposing supply or demand level there. Right? It's a very simple thing to look at, but it really helps stack the odds in your favor or tell you that the odds are not stacked in your favor, if that makes sense. So we start with, yeah, so the process is we start with current price and we go down and left without cutting through candles until we reach the picture that represents, supply or demand, whichever one we're working on or looking for. In this case, it was demand. And there it is. Okay. So that's the 129.23. And again, if you have other markets you want me to look at, just type them in. It's not a problem to go look at them. Not a problem at all. Let's go over to gold. Yes, we can look at gold. We spent a lot of time on gold this morning. Yeah, Haji, absolutely. So we go over that a lot. You can watch some of the videos too, for a lot of videos on the basics. So let's take a look. What we've been in the morning sessions, we've basically been playing gold off of the weekly demand zones, was zone right there, up to the supply zone that's very clear on the daily. And we haven't even hit this yet, right? So price is likely headed up there. Remember, fresh supplier demand zones are not just turning points, they're actually magnets for price also. If we come down to a smaller time frame, let me find it for you here, but I know I have some levels for you. There we go. So in gold, on the smaller time frames, you can see where current prices, 13 obviously 04, our significant supply is higher, about 30 points higher. Our significant demand is quite a bit lower. So not a whole lot to do here. And it's no coincidence that our fresh supplier demand is quite a bit higher and quite a bit lower, because take a look. When we go back to our, again, that context of where price is in the larger time frame, just look at the daily or weekly. Aren't we just right inside this range, this price range? We've been in it for a month and a half, for 6 weeks. The dollar's just been in this range. So you would expect that your significant fresh supplier demand or demand levels and demand levels are much higher and much lower. Okay, let's keep going. A new actionable level that may come into play today, though. Oh, we did get up here. So this is a supply zone we went over earlier. This was 1308. And then on the demand side, we have two levels that we're looking at. Let's just focus on one here. There it is. About a 2 point level starting at 1296. I'd call it 1296.50. Your profit zone, which is the distance in between your supply and demand, is very clear there. So, um, and it looks okay. It's not great. When you say a strong candle, what do you mean? Like a strong move out of that level? Is that what you mean? Okay. Yeah, remember you have the basic pattern that represents where banks are buying and selling in a market, and then you have a number of odds enhancers, right? You have a number of odds enhancers. Okay. So one thing I want to point out here, though, so this is a classic example of, while you have clear supply and demand above and below, you're probably going to be right in your predicting where price is going to turn and where it's going to go, but it doesn't necessarily mean that this is a trading opportunity you want to take. You have to have the risk reward that you're looking for, and if you don't have it, um, you might be right in predicting where price is going to go, but it doesn't mean it's a trade you want to take. All right, let's look at another market. So gold is just it's just doing its thing. It's turning at the levels. The other big point I want to continue to make is, what you'll find over time is, don't overcomplicate this. Price just moves from fresh supply to fresh demand, and back again until all those orders are gone. So ultimately, that's what you want to focus on, whether you're day trading, for that daily income, weekly income, building or protecting longer term wealth, and so on and so forth, right? Let's look at the Euro Canadian, no problem. Here it is. Let's just wait for the charts to update, and then we'll take a look. And I like this one because I don't believe I have any, Fahad, I don't believe I have any lines on this one. So as soon as the charts catch up, then we'll do the analysis together. Does that work? And we'll run through the process of how we find our supply and demand zones, our market turning points. Your daily income, Haj, your daily income time frames are typically, your smaller ones, right? So I would always have a larger time frame in there, something like an hourly chart or bigger. And there you just want to know where so you know where price is at in the bigger picture context. And then of course your smaller time frames would be your in the FX markets. I wouldn't go lower than a 5-minute chart. So maybe your 5 and 10 minute chart is really all you need, something like that. Keep it simple. The key is to keep it simple. All right, let's look at the Euro Canadian. So I'll always start with the larger time frame really quick just to get some context. And I see us just trading sideways here. Quick peek at the daily chart. See if it just shows me anything different. It doesn't. Well, it does a little bit. Okay. It shows me that we are in this range, right? But um, that we have some supply zones above and probably not too much demand below. But now we need to go down to a smaller time frame and investigate. So on this one, oh, this is a good one. So for those that are new here, um, looking at this chart, where would you say supply is? Well, let me answer this question specifically. Where's the fresh supply zone above current price on this chart? Where's the fresh supply zone above current price in this chart? I'll give you a few seconds to answer and then I'll go over it with you. And remember to walk through the 2 basic steps. Okay, 154, 152. All right. So what we do is, so I see a lot of 152s. It's not 152. The reason why it's not 152 is we've been there so many times. Even if we've been there, once or twice, it's still too much. Remember, if you're saying 154, you have to understand this basic concept. Every time you return back to a price point like 152, what's happening to the supply at 152? Is it increasing or is it decreasing? Every time you come up to rally up to 152, is it increasing or decreasing? Yeah, it's decreasing. It's getting eaten up. In other words, the sell orders that are sitting there making its supply are getting filled, which means less supply. Now, if your mind naturally or just tells you increasing, it's because that's what the trading books say. The trading books or internet information that focuses on conventional technical analysis is literally backwards. That's why you don't see people making a consistent low risk living year after year using that information. What those say is, they talk about the term support and resistance. And what they say is, don't buy or sell at a level the first time price hits it. Let the level be tested a little bit. Let it be tested a few times and then get in, right? Isn't that what all the information out there is? Well, think about the message that's really what that really means. What that's saying is, don't take the high probability trade, take the low probability trade, right? Does that make sense? Yeah, and Haji, that's what we're doing here. Okay. So what we want to do, watch the screen. We want to start with current price, which is right here. And I take my mouse, and you want to go up, and if we're finding supply, you want to go up and left without cutting through candles. Up and left, right, without cutting through candles until we reach the picture that represents fresh supply. So we keep doing that here. None of this stuff is supply. That's why I keep going up without cutting through candles. But here we have a little bit of supply, right? Banks are big sellers of this market. Euro Canadian right up here. So there's that. Now, let me get a rectangle in there so you can see it real easy. Okay, so there's that, right? So notice I just went up and left, and I kept going, I kept moving higher and left until we found the picture that represented fresh supply, where banks are clearly selling this market. Now, price is all the way down here. Do I know for sure that price is going to go up to the supply zone or when? No, of course I don't. But if they do, we've identified retail prices where we always want to be a seller. And think about what will happen if and when price gets up there. And only focus on what we know to be true. Someone will be buying after a rally in price. Big mistake number one. And into a price level where supply exceeds demand. Mistake number two. Okay? All right. So I think you get the point. Yeah, so Charlie's saying it seems like I like small basing. We do like small basing. Why is that? It comes down to answering this question right here. Uh, that one. Now, if you look at the first question, where will price turn? Okay. So price turns at levels where supply and demand are most out of balance, right? Okay. But let me ask you, at price points where supply and demand is most out of balance, do you get lots of trading activity or very little? What do you think? In other words, if price is up right up here in where we're, on the top with these red stick figures, are you going to get lots of trading activity or very little? Many transactions or very few? No, you're going to get very little. Okay. Now, at that same price point up here, you have the potential for a lot of activity. You just don't get it because all that potential is on one side of the market, the buy side or sell side. Does that make sense? So, less trading at a price point means a bigger supply and demand imbalance at that price point, right? Now, again, that's backwards of what all the trading books say. What do the trading books say? The trading books say, um, what areas on the chart do they have you focus on? Okay, here's our euro. We'll go over this one in a minute. The trading books say focus on areas in the chart where you have lots of trading activity, many candles on the screen, above average volume, and they say that's where your turning points are. But if you think about it, where do you get most of your trading activity? Where do you get all those candles on the screen? Where's conventional technical analysis having you buy and sell? And answer the question by looking at these stick figures. The picture there represents real supply and demand, but where do you get the most trading activity? Where do most trades happen? Right in the middle. Yeah, exactly, Charlie. Can you see how at the top and bottom you get the least amount of trading activity, right? See that? So again, conventional technical analysis and all that stuff and everything it's based on has you looking in the wrong areas and taking the wrong action. Everything you need to do, or you should consider when making a decision, has to be based on pure supply and demand because that's the only thing that causes prices to turn and move in markets. Okay. Right. Okay, let's move on. And again, if you have a market you want me to take a look at, just throw it in the chat. That's what we've been doing. Yeah, Haji. So price, some of your best levels, price will leave in strong fashion. That's a key odds enhancer. But I think the mistake you're making is thinking that there's always high volume associated with that. That's not the case. In fact, a lot of the time it's low volume in those big moves from levels. Okay. So here's euro. Not much to look at in euro because it's kind of right in the middle of its move. In our group, we were looking to get in this down here, and many people did. So we're just kind of hanging on to that and leaving it alone. Let me get to the. So this is a chart we started with, and we're looking for this market to rally all the way back to the level up here. And if it does, we'd be looking to take a short position up here, or an options position like buy puts or something like that, right? And this is the Dow. And just because I'm showing you a Dow chart doesn't mean you have to take a trade in the Dow. You can use this chart in this market to make a decision in the S&P, in the Nasdaq, um, you know, um, really any of the equity index markets. Yeah, let's look at the Euro spot. Okay, let's do that. Okay, there it is. So, oh, I didn't realize it, but this just hit our level. So yes, we have a. I didn't realize it that actually hit our level. Okay. So this one just met entry. So if you're interested in this one, if it rallies just up just a little bit, 1272. So it's just like 2 pips higher. We have a nice profit zone below with this one, and the risk is fairly low. So yeah, your risk reward on this one is decent. Looks like about 3 to 1 to the first potential stopping point, and then if you get past that, there's a much bigger profit zone below that. But that's a big if. And of course, we need to watch the dollar also. So now you see how little trading there is inside our actual zone here? There's only like 3 or 4 candles. That's because the potential volume on the sell side is huge. It's up in here where you have all these red stick figures. See that? Does that make sense? Okay. All right, let's keep going. Right, pip. So there's not, yeah, that one again, that was maybe offering, 4 to 1, which means you want to take something less than that. So I'm not really interested in that, but some people are. Yeah, Haji, a lot of people think big moves in the market are accompanied by large volume, and that's not typically the case. It's not all, certainly not always the case. Okay, let's keep going. So when we look at, we're going to look at bonds here for a minute. One of the things we talked about last week in the sessions is that the bonds are likely to stay in this very tight range because you have supply and demand so close. And that's kind of what happened all week last week. This week, we'd be looking for bonds, specifically the 10-year like this, to move out of this range. Okay. So that will likely trigger movement in the equity index markets and so on, even the dollar. Um, yeah, we can certainly look at stocks too. Apple is one we can look at. One we might want to look at first, though, is Amazon. Let's take a look at Amazon. And if we go to the daily chart, you'll see we identified some supply just above at 1858. So be careful. This is obviously a very expensive stock. I know some of you want to look at stocks, but this is a very expensive stock. But you can always play these stocks with options too, right? Yeah, we'll look at some of these other markets in just a minute. So there's Amazon. Again, 1858 up to 1894, that area. Likely to be some supply there. And then, of course, decent profit zone below, but not great. We can look at Apple. I didn't see anything in Apple, but we can look. And there you go. It's just cruising higher, right? But let's look inside this drop over here to the left and see what it's running into. So let's go down some time frames. All right, we're starting to get a little clarity by looking at the 4-hour chart. Let's go down another time frame. No, Pip. A lot of times those levels are fine. That I wouldn't see that as a reason to cancel a trade. But what you can do is, I don't know exactly how you or anyone else in the group looks at the charts and what your eyes see and what your brain processes most importantly. So if you want, feel free to email me a chart or two. I'm happy to take a look to make sure that you're on the right track with strategy. Okay, so we look at the smaller time frame of Apple. Oh yeah, we want to look at the supply side and see what's up here. So we see we have a gap. Let's go a little bit lower. Yeah, I mean, Apple looks like it has some room to run, so I'd leave this one alone. But up in here, um, yeah, that could be a nice opportunity. It's got a gap down and everything else. Just reading back in the chat here. Let's look at the dollar yen. So we can go to, let's go right here. So the dollar yen in our morning sessions, we've been looking at this, this 180 chart. And like the Swiss and the euro, we hit demand and have been rallying, off of that. This market is now hung up because we have supply zones here. But if the price did pull back again, and some we haven't talked about lately, but we would take that entry again. So if the first time price comes back to a level, it just touches the level and turns. Typically, we want to get in again, and or for most people, that's going to be their first entry, and that's fine too. Okay, but that first pullback where price just touches the level, that gives us lots of evidence that there's quite a bit of demand sitting there. Does that make sense? And again, other than oil, most of these markets are right in the middle. Wanted to lay out the equity index opportunity for you today. Wanted to lay out the oil opportunity. And let's see here. Okay. So let's see. So here it is. Whoops. Well, instead of me typing my email address in the chat again, there it is, sam.seiden@tradingcabinet.com. And because I know we're out of time here, but remember, everything we do needs to focus on answering these two questions: where will price turn, and where will it move to? And the answers need to be objective, right? Unfilled orders cause prices to turn. Filled orders facilitate price movement. If you have any questions or are struggling at all, feel free to send me an email, and I am happy to help. We can, we'll figure something out. Your day trading, weekly income, wealth, long-term wealth building and protection, protecting accounts. If you're struggling with any of that, I'll do my best to help you. Have a great day, everybody, and we will see you soon.